Chapter 5, we start to cover unemployment taxes. These include two different taxes. One is called FUTA, and the other is called SUTA. FUTA stands for Federal Unemployment Tax, and SUTA stands for State Unemployment Tax. And first of all, we have to know which employers are covered and have to pay for FUTA and SUTA. So who is an employer for FUTA? If the employer pays wages of $1,500 or more during any calendar quarter is 3 months, okay, either this year or last year, there's even just one 3-month period that they paid wages of $1,500 or more, then they automatically have to take care of FUTA. If they employ at least one person, even part-time, in each of 20 weeks of this year or last year, then, and even if that's less than $1,500 that they paid out, if they have at least one part-time person for 20 weeks, anytime this year or last year, then they automatically have to pay FUTA. As far as SUTA is concerned, each state has their own rules about who has to pay SUTA. Most states are similar to the federal laws. They all started together in the mid-1930s. And so they all started out the same, but then there's been changes over time. There are some differences. You need to know the specific laws for each state if you're doing payroll for the employees that are in that state. The biggest challenge is for employees who work in more than one state for the year. So if we have some interstate employees, we put that employee in the state where the work is localized, meaning the state where the employee is doing most of their work. So if an employee works mostly in South Carolina, but they do some work in Georgia, then we're just going to put all of that employee's wages in South Carolina. However, if that doesn't work, let's say they work fairly evenly in South Carolina and Georgia. Maybe they're spread out all over the Southeast or something. They work some in each state. So there isn't one particular state where they do most of their work. Well, in that case, we'll use the second rule, okay? We'll put them in the state where the base of operations is. So that's like headquarters of the office. So if this employee was working equally in South Carolina and Georgia, but the headquarters office was in Georgia, then all of their wages, we would have to pay FUTA to Georgia unemployment and none to South Carolina. Now, what if the headquarters is in Tennessee? It's not in either South Carolina or in Georgia, which are the two states that that employee works in. Well, then we need to use Rule 3. We're going to put them in the state where operations are directed. So even though the headquarters might be in Tennessee, there might be an office which, like a regional manager, is in Georgia. And that regional manager is in charge of North and South Carolina and Georgia. And so that regional manager will dictate to the employee, and that regional manager is in Georgia. So we will put the employee's FUTA into Georgia, or SUTA into Georgia. Now, let's say there's not. Let's say the headquarters is in Tennessee, and that's where the regional manager is too. Okay, for the whole Southeast is in Tennessee. And the employee doesn't work in Tennessee, only South Carolina and Georgia. Okay, well, in that case, none of these three work out. We go to the final thing. we put them in the state that they live in. So if that employee lives in South Carolina, that's where we're going to pay SUTA to the state of South Carolina. Okay, so the next few slides just go through what we were just talking about. The place where the work is localized is where they're mostly working. Okay, if one of the states is considered more of a permanent state for that employee, and the other states they work are considered just temporary, even though they did a lot of work this year, it was just a temporary thing, and they're coming back to the permanent state, then we would use that permanent state as being the state where it's localized. Okay, the base of operations is like a headquarters, and it would have to be where the employee themselves has an office, or where that employee receives instructions, and that has to be in the state, in one of the states that the employee is doing at least some work. So if the employee is only working in South Carolina and Georgia and is doing no work in Tennessee, where the headquarters is, then you can't use this. Again, this is the same kind of thing. There's no actual base or office for that employee, but there's some kind of regional manager, the employee's boss has some kind of office in one of the states that the employee actually works in, then we'll use that state. Okay, here is talking about an employee that gets transferred. So here's an example that ABC company paid wages of $4,000 from January 1st to some future date to John in South Carolina. Then they transferred him to North Carolina, where he made $7,000 in wages in North Carolina. Well, in the case of a transfer like that, it's not like he's working mostly in one state, but a little bit in another state. He was transferred, so his permanent workplace was South Carolina. Then he got transferred, and now his permanent workplace is in North Carolina. Okay, so in this case, we're going to pay SUTA to South Carolina until he gets transferred. Then we're going to pay SUTA to North Carolina from the time he gets transferred until the rest of the year. However, since each state has a certain maximum of wages, rather than having to start at zero again when you move to North Carolina, if there's a transfer like that, the second state gives credit for what you've already done. So North Carolina will give $4,000 of credit toward the stuff that was already done in South Carolina. So the $7,000 in North Carolina will subtract the $4,000 of wages that were earned in South Carolina that year. So we'll only have to pay SUTA based on $3,000 to North Carolina. Okay, here's non-taxable wages for FUTA. These are things that don't count. We don't have to calculate FUTA based on these things. Reimbursements. So if I go to an accounting conference, I pay out of my own pocket for the hotel, and then OC Tech reimburses me back. That's not wages, and OC Tech doesn't have to pay any FUTA or SUTA on reimbursements like that. If you get retirement or death or disability amounts of money, those are not considered wages. No FUTA or SUTA would be paid on those. Courtesy discounts is if like you worked for a shoe store and you were doing the payroll for a shoe store and the shoe store allowed you to have a 20% discount on anything you buy in there because you're an employee, that's a courtesy discount. That's a benefit, but it's a non-taxable benefit. No FICA, no FIT, and the employer doesn't have to pay any FUTA. Educational assistance. If the company is paying for you to take a class, then again, that is a benefit to you, but it's a non-taxable benefit, and no anything will come out of your pay of that amount of money that helps you. Health insurance is another benefit. If the employer pays some health insurance for you, then no taxes will come out of that. Workers' compensation. If you were injured on the job and you're getting workers' compensation wages come from the insurance company, then those are not considered wages as far as FUTA is concerned, or SUTA. The FUTA tax rate. Now the FUTA, the federal unemployment tax, is only paid by the employer, never taken out of the employee check. FUTA is a plan B. If a state runs out of money to pay to the unemployed, it borrows from FUTA, then it has to pay it back. So South Carolina, in the financial crisis, I think it might have been 2012, ran out of unemployment money to give to laid off people, and they had to borrow from the state. So that FUTA money is there for states when they get in trouble and they need to get some extra money to pay to unemployed people. Every employer has to pay it, though, regardless of if that employer ever laid even a single person off. It doesn't matter. All employers have to pay into that pool of money so that it's there if it needs to be. It's only a small amount that the employer has to pay, but each employer has to help pay. Okay? So the gross FUTA rate is 6%. So if I move the decimal places over, that would be 0.06. However, there's a 5.4% credit against that, as long as the employer pays their SUTA on time. So why is the FUTA worried about the SUTA? Because the FUTA is having to help the state out if the state gets in trouble. So if the employers are not paying their SUTA on time, it's more likely that the state will get in trouble. So FUTA says as long as all the employers pay their SUTA on time, we're going to give you this huge credit. Almost all of it is going to be, not where you have to pay it. Okay? And so if you take the 6% gross rate and minus that credit of 5.4%, that's only 0.6%, which is 0.006. So it's so much. So here we have an example. If an employer has $10,000 of taxable wages for FUTA, they pay their SUTA on time, they will owe $60 for FUTA, which is 10,000 times this 0.006, $60. But if they don't pay the SUTA on time, they'll owe $600, 10,000 times 0.06. So if you are the payroll person who's in charge of making sure this gets paid, and you don't pay the SUTA on time, and all of a sudden your company's having to pay $600 instead of $60, you're going to find yourself fired. So you have to be very careful and make sure